Hi everyone, my name's Alex and I'm going to be talking to you a little bit today about the research that we've undertaken to understand the value of data in the FTSE. I think most people would agree with this statement: data is valuable. That's because often data goes hand in hand with organisational performance. However, value as a term is troublesome. It means many things to many different people. So whenever we talk about value, often the conversation drifts to how much is that data costing us, how much are we spending, or perhaps how much can we sell it for. And while these are all important facets of valuation, it means that we often overlook the value of those data to our organisation and the stakeholders they serve. So focusing on spend and cost is important, but it means that we can inadvertently focus on the wrong place. It might mean we're trading off against the value that we create for some stakeholders at the expense of others. At Anmut, our belief and our ambition, is that we help data leaders understand and then communicate the value of that data. How that data improves organisational productivity, creates benefit, even leads to financial returns. And of course, I'm going to say it, but by placing a monetary value on data helps us change the conversation, change the way that people think about it. And we've just heard that from Dad the first time. And our belief is that by bringing that into the conversation means that a whole organisation can start thinking about not just the lip service of data is valuable. We can actually move towards somewhere where we can allocate resource, capital, and even prioritise investment, and bring data into a broader conversation around which assets do I need to deliver value for these stakeholders. So we've taken the lessons learned working with organisations like National Highways, DVSA, to the FTSE. Specifically, we've looked at the 10 largest sectors in the FTSE 350 to understand what data is worth to them and their stakeholders. Now, if you total up the value, the market value of all those organisations, you get an eye-watering £1.5 trillion. And this is just a sliver of the FTSE. But how much of that is due to data? When we did the analysis over the FTSE, we came up with a number of 295 billion worth of data assets in the FTSE 350 for those top 10 sectors alone. But data is not equal across all of those sectors. If we zoom in on banks, for example, we see that there's over 240 billion worth of market cap in the banking sector alone. And in the pink, at the bottom, is our estimate for how much data is worth as part of that. But every sector tells a different story. Sectors that have that require a deep understanding of their customer, or perhaps intense research and development activities like pharma, oil and gas, see higher data values. So, how do we get to this number, this magical 72 billion? Well, to do so, we use a thing called data dependency. It's a measure we've been using for several years, working with organisations like National Highways and DVSA, crafting that over time. But the underlying assumption is that organisations depend on data to achieve their goals and perform their activities. And we use 15 indicators in order to assess that for an individual organisation. Now, due to the breadth of the research here, we're looking at an awful lot of organisations at this scale. We've used a subset of these indicators. And we use publicly available information from like the ONS and other sources to try and answer those indicators. And those indicators talk around these sort of themes. So how much is data used in your activities? Could the activity be performed with or replaced by another asset? Or what level of analysis might be required? And that public information includes things like presence of a chief data officer, how much you're spending on various assets, how you're using AI, for example, or even a level of analysis. But the takeaway point is a greater data dependency means that there's a greater reliance on data to achieve its goals and perform its activities. And this is our initial estimate for that. So you can see the sectors running on the bottom there. But the takeaway is, the taller the bar, the greater the data dependency. Let's make this a little bit more tangible. So let's focus in on banks and beverages. Over on the right-hand side, we have banks. were the largest data dependencies in the analysis. Perhaps this is intuitive. There's an enormous volume of financial transactions that happen in real time, and the accuracy required of those transactions is quite simple, let alone the amount of SOC capability that's required to protect that asset. In contrast, we have beverages, which is a lower data dependency. Now, to be clear, that isn't to say that's good or bad. It's also not to say that beverages don't give a damn about data. Clearly, that's not true. It's a pivotal part of their supply chains, etc. But it's to say that they naturally lean less on data. They're very physical asset heavy. Their logistics centres, their assembly lines, their production plants, the list goes on. So naturally, they lean less on data. But under the surface of these bars, bubbling underneath, is that data assets are worth differently to different organisations. Different data assets don't even exist across sectors, so it follows that some assets are worth more and relied upon more than others. Now, while we can't assess individual data assets and their contribution to organisational value at this scale, and yet, maybe one day we will, that's a good ambition to have. Instead, what we've done is we've analysed the share price of these organisations. We've looked at the events where those organisations have deviated from the market and their peers and categorised the events into the buckets that you see on the screen. So events that are related to building a strong reputation with wider society, supporting the economy, etc., or even their impact on natural resources and the environment fall under society. Those events that are related to debt flow, debt management, cash flows, etc., will fall under financial primarily. And then where an organisation is investing in itself for long-term prosperity, for example, an oil and gas exploration hub that won't be realised until a decade later, would fall under transformation. When we look at the value attribution to those different buckets over the last 5 years, the most value falls into that societal bucket. That's to say that those events are affecting organisations' share price, left, right and centre, regardless of sector, regardless of organisation and business model. Now, we were quite surprised by the dominance of the societal outcomes there. But if you think about what's happened over the last 5 years, and Dan's actually just spoken to some of those, we've got a cost of living crisis going on. We've had several of them over the last few years. We've seen the rise and fall of the pandemic. And of course, rightly so, we're pushing for a greener, build back better economy. And while we can't go into the detail here, I'd ask everyone that's in these organisations to be thinking, what are the activities that I do to create those societal outcomes? What are the assets that I need to drive those outcomes? Because they're going to be ever more valuable in the years to come. So far, we've understood the outcomes that the market values by sector. We've started to understand the reliance on data to deliver those outcomes, and now we can bring these two ships together to attribute some of the value associated with those outcomes to data in monetary terms. So let's return to our example from banks earlier. That's £72 billion worth of data asset. We can now proportion by the amount of value that we've seen over the last 5 years by changing the stock price. The data that's supporting those societal outcomes is a whopping 26 billion. So that's, in the specific case of a bank, that might be how we are increasingly applying pressure to finance the transition to a greener economy. In yellow, towards the bottom of the chart, you can see that 14 billion. That's the data that's required to create those functional and emotional products and services that banks rely on a day-to-day basis. And again, we won't go into it today, but you can see the dominance of that societal data asset across all of the sectors there. But remember, we've just looked over the last 5 years. The future is a slightly different story. New use cases, new technologies will come online, and with that, the dependence on data will likely increase. Likewise, some data assets that support those use cases will become increasingly valuable. We've seen over the last 2 years alone the explosion of AI. As we venture into a future where we're requiring increasingly specific use cases that use increasingly specific models, which are trained on increasingly fit-for-purpose specific data, those data assets will skyrocket in value and potentially be the difference between keeping up with the herd and being in front of it. And even internally at Anmut, we've been using a data asset that we've been building for 5 years and using AI to create more value from that. So data is worth billions, at least to this sliver of the FTSE talked. And it will likely increase in value, and we will become more dependent on data in the years ahead. So in order to make the most of the opportunities, but also navigate the incredible costs and risks that come with that, every data leader in an organisation should be asking the following questions. Which data assets are valuable to my organisation today? Which of those data assets are being well managed? And finally, which data assets will be valuable to my organisation tomorrow? Thanks very much.